Let's dive a little bit deeper with policy loans. So in our last video, we looked at a 35-year-old individual with Guardian, 100K per year for 5 years going in, and we looked at their fixed loan interest rate. Starts out at a fixed rate of 5%, eventually drops to a fixed rate of 3%, and we've got the discount if we elect to pay the loan interest prior to the anniversary date. So what we're going to look at in this video is the exact same scenario, same 35-year-old individual, funding 100K per year for 5 years, the loan of $300,000 in year 6. And here's the difference. We are going to elect at the 10th year the variable loan interest rate, which gives me a rate of 4%. What it also does is change the policy to a non-direct recognition policy. So this will be interesting when we look at the loan study. Actually, I made a mistake here. I said loan of $300,000 in year 6, not year 6, year 11 in this example we're going to look at. All right, let's have a little bit of fun, shall we? We will begin not with this board, but with the actual illustration. There we go. So here's the same illustration we looked at in the last video. This is the growth scenario, so we don't need to spend much time on this. There's the 100K per year for 5 years going in. There's your cash value buildup. This is good just to validate the loan scenario. When we start to look at comparisons of illustrations, you always want to make sure that the illustration is exactly the same. Meaning I don't want to see a growth illustration and then a loan scenario where I tweak the design of the policy because then I've got a different case. I need it to be apples to apples every single time. So, variable loan rate, here we go. Have some fun with this. Same policy, everything's identical. Difference is this. One more page. There we go. So, you see the 100K per year going in for 5 years. Here's your actual loan, $300,000. This is the interest payment. So each year the interest comes due, it assumes we're going to pay it. The loan interest is 4%. 4% of $300,000 is what? $12,000. What's your interest payment here? The interest that came due, $11,538. This assumes we're paying the loan interest each year. So as $11,538 comes due, we pay it out of pocket. Why this reads negative $288,462 is because illustration software likes to make things confusing. That's not why, but it can seem confusing. Year 11, it assumes a $300,000 loan is taken. Loan interest comes due of $11,538, and it assumes we paid that out of pocket, the loan interest. So when we look at the detailed illustrations, it's assuming $300,000 went out to you, if this is your policy, and then you paid $11,538, which means the net out of pocket, the net amount you received just from a transactional standpoint with the insurance company would be that $288 and change. When we lay this on Excel, it'll get much easier. Let's take a look at Excel, shall we? Which we just plop all of this data on the spreadsheet and look at it side by side. So let's look at the variable rate here, which will begin with this guy. This is the 4% loan interest rate. Here we go. Up top, you can see that. And this is the exact illustration we looked at in the growth scenario. This is the loan repayment, which we looked at the loan interest payment with a detailed illustration. We can pull that up, but this video would be an hour if I went through every illustration. So there's the growth, everything just like the last video. 100K per year for 5 years, total of $500,000. By year 5, I've got more than $500,000, $501 in cash value. Now over here, annual loan, we're going to take this loan out of $300,000. You might take this out for, maybe it's an investment property. It can be for whatever you want. Now, that $300K comes out. What's the impact of that policy loan? $358 in cash value. If I let it sit and grow, year 11, what do you have? $658 in cash value. $658, $330. Over here, $358. What's the difference there? When we look at the death benefit, what's the difference there? If I let it sit and grow, $1,766. Over here, $1,466. Dollar for dollar reduction on the death benefit. I borrowed $300,000. If I die the next day, that's the net death benefit paid out. This is the net cash value I can access, net of all policy loans. So here, loan interest comes due. I elect to pay it each year. Purple is what I'm paying. And then in this purple column is what I'm repaying toward the balance. So each year, if we look at year 13, for example, I paid $30,000 in principal plus another $9,231 in interest. So my total net out of pocket was $39,231 toward loan payments, principal and interest in this case. When it is paid in full, what do we notice here? Cash value, $1,050,000. Death benefit, $2,194. How about over here? When I just let it sit and grow? $1,050,000. Death benefit, $2,194. Everything is fully restored to exactly what it would have been as if I never touched it in the first place. Continues to appreciate at the same pace as well. The reason why is because this is a non-direct recognition policy now. I'm receiving the same dividend interest rate of 5.65% on money still in cash value, my remaining equity, and on the loaned dollars that I've borrowed. Interesting, isn't it? Let's take a look at the no repayment scenario. What was the loan interest in the last example? $11,000 and change. What do you notice here? $312. Should have wrote this a little bit differently. The policy loan is $300,000. This is your policy and you request a loan of $300,000, you would get $312,000. That's sent via a check to you, not $312,000. Why the annual loan reached $300,000 is because we take the $300,000 loan, we don't pay the loan interest at 4%. I'm not paying it. Remember, I do not receive the discount rate. 4% is $12,000. If I don't pay it, the policy will take a loan against itself to cover that loan interest expense. So the software, when we actually look at illustrations, books a $300,000 loan that I take, plus it books an additional $12,000 loan internally. That's why the annual loan reads $312,000. Hate how it works. Sometimes we just put $300,000 in there and explain the difference between the Excel spreadsheet and the detailed illustrations, while the values over here all match up. So as we look at this guy, if we go down to age 85 here, same thing. What do you notice? Different case than the direct recognition scenario we looked at in the last video. Value continues to appreciate here. Last example, it went south. It does not automatically mean that non-direct recognition is better. What's going on here, why this guy looks so much better than the last video, if you hadn't seen the last video, we had a fixed loan interest rate at 5% and we did not pay anything when we looked at the no repayment scenario. What happens with direct recognition contract with Guardian? They reduce the dividend to 5% on the borrowed cash value on the $300K loan balance. In this case, the dividend of 565 is applied to the borrowed amount and the remaining cash value. It's consistent on everything, where I only have a loan interest rate of 4%. So I'm able to outpace everything on paper. I say on paper because things change over time. And then we've got paying the interest out of pocket. Here we go. So if you like to pay the interest each year, what will things look like? There's the loan that comes out. You'll notice the same case in all the examples, $300,000 reduction. Time passes. What happens when we hit 65? What happened in the last video when we hit 65, if you've seen that one? If you keep the fixed loan interest rate, the loan interest rate actually drops to 3%, and you'll see your out-of-pocket toward interest payments go down. If you select the variable loan rate, that does not happen. It remains variable forever. If interest rates remain low forever, then we would have a 4% loan interest rate forever. Likely that likely will not happen. But as we look at this, it's 4% indefinitely. Once you go variable, there's no going back to fixed. So it's good to be aware of that. You have 10 years to make that decision, and then you've got 60 days at the 10-year mark to actually make the decision. That makes it nice and fun from a crunch time standpoint. In any event, hope you enjoyed this video. The next one will be the last one. We'll have a lot of fun with that. We're going to look at the 10-pay product and someone a little bit older, but we'll have some fun. If you did enjoy this, please hit the like button, subscribe for more, and as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.